Hey guys, Chris Dorn here with We Buy Businesses, and I'm here to go over our cash flow management system, give you guys an idea of how we manage our companies and if we can insert this system into other companies that we're looking at. Disclaimer, doesn't apply to every company. It's not the all-in-one golden rule. It's just something that, for that company that's been operating 10, 20 years, 10 to 20 employees looking to find a solid growth model, this might be a good fit. Some instances it's not a good fit is startup companies, for example. They typically run at a loss for 3, 5, 10 years, whatever their business plan is. And actually, because growth costs so much, it takes so much cash, companies growing 50, 100% a year, this doesn't really apply either. It might be a goal that they'll strive towards after they've maximized that upside equity. But I'd say long story short, this is how we make maneuvers, how we hire people, how we decide to when to buy equipment, and it gives us a lot of certainty in our transactions financially. So let's get into it. First things first, our net margin. And 10% to me is break even. After your inflation rates, after taxes, there's not really a lot of cash left over, whether you wanted to invest those retained earnings or pay to shareholders. That's a big problem. So for us, we aspire 15%. Now, when we're hiring, net margin is everything to us. So for example, we might be at 12, 15%, and if you're not, you'll have to work up towards it. Then you'll hire back down to 10 to 12%, because again, that wage has now been added to your company. It's going to lower that margin. And then you work back up 12 to 15%. You know, businesses aren't perfect. There's always somewhere to improve and market share to gain. So this is essentially what you do. You're hiring down your margin, growing it back up to hire back down, and you're going to grow with good leadership, good people on your team. And that's, in my opinion, the way to look at it fundamentally when you're hiring people. Too many entrepreneurs get emotional about it, bring on somebody, and then all of a sudden realize I don't have a net or what have you. So a lot of entrepreneurs get caught in that, and that's essentially how we do it fundamentally. Moving forward, the most important margin ultimately is your gross margin. And the lower the gross, the slower your growth. So essentially, one trend we look at is what's our gross margin after our cost of goods, and we typically have a 70 to 75% minimum. There's other ways there's other definitions of gross, after your labor and your cost of goods. That's fine too. Make sure your gross is healthy. That's the key point here, because if your gross is 10-15% after your labor and everything, your operational margin, whatever that is, if your gross is too thin, you have no cash for growth. And here's the thing, if you stay the same, okay, long-term inflation is going to eat away at you. So if you're not growing, you're contracting. This is a problem. So you don't want inflation to affect you if you're going sideways. That's a big problem. So lastly, before I get to my big point, managing cash. And I see this. Jim down the street, let's say his bank account has $100,000, that's his working capital, and he goes, okay, I can make this purchase. He goes out and buys a $50,000 piece of equipment. He's happy about it, he's great. Then all of a sudden, he needs to pay his payroll tax. His GST is due. Oh, and now there's corporate taxes. Before you know it, now Jim is in a negative cash position, and he's sweating bullets. And now he needs to figure, now he's got a second problem here. So my point is this, guys, when you're managing your cash, always figure out what your working capital is and maintain that, and always account for any upcoming expenses. Maybe you're paying your insurance annually or something, budget for that. Maybe it's your taxes. Again, budget for that over and above your working capital. And so if Jim wants to buy that $50,000 piece of equipment, the smarter approach is cash up to $200,000, Jim, then buy your trailer, pay your taxes, and you still have your working capital. So hopefully that explains that in a short period of time. And then lastly, I'm gonna hit, this is my key point here, guys. With a solid cash flow management system, you shouldn't need investors to grow. Why give up equity when you don't have to? Not that I'm against that, by the way, but why give up equity when you don't have to? Doesn't make sense. You don't have to go to the banks and acquire debt. Essentially, you're growing with your net cash, with your improved cash trend from your improved net margins and hopefully your improved gross margins. All these systems are working together. You're hiring fundamentally, you're buying equipment fundamentally, and it adds that certainty. When we buy something, we know with 100% certainty that the company is going to be in a great cash position, and we're still growing, and cash flow is a big part of that. So guys, hopefully this adds value to you. Again, this is Chris with We Buy Businesses.